Hello and welcome to the LA Venture Podcast. This is Minnie Ingersoll, host of the podcast and partner at TenOneTen. TenOneTen is an early stage venture fund based in Los Angeles. We're all technical founders who like to invest in technical founders. As one of LA's earliest seed funds, we've gotten to know the other investors here, and this podcast is a fun way for us to catch up with some of the other great LA investors. Eric Manlunas is the founder and managing partner of Wavemaker Partners. Wavemaker is an early-stage venture fund that's dual-headquartered in Los Angeles and Singapore. Eric has invested in over 350 early-stage companies, so truly one of the pioneers of LA entrepreneurship. Before Wavemaker, Eric was investing out of Frontera and was twice a founder himself. Eric, thank you so much for coming on the LA Venture Podcast.
Thanks for having me.
Well, it's a treat. I think you've got such a unique structure of all the things you're doing at Wavemaker. So I'm hoping I get to have one interview where I ask you about like 4 or 5 different things.
Sure. Happy to talk about. Yeah, we're a little different that way, but happy to talk about the entire Wavemaker story and how we've evolved to where we are today.
Yeah, great. I mean, I think it's a good place to start, which is just there are different components. You're seeding startups, you're seeding funds, you're running a studio. Why don't you tell me about sort of high level, all the different activities?
Sure. So as you've mentioned in your intro, we're a bit multifaceted. We're not only dual headquartered in Singapore, but we're doing a bunch of different things in terms of the early stage ecosystem. So our main focus has been early stage for the last 17 and a half years. But we're a bit horizontally integrated in that space. What that really means is we invest, we build, and most recently we started advising and working with family offices and small corporates. We both invest in the US and in Southeast Asia. We have dedicated funds on each side of the market. On the venture building side, we have a division called Wavemaker Labs, which is essentially a venture studio that primarily focuses on robotics and autonomous concepts. So we're building about 4 companies right now along the lines of an autonomous lawnmower, a robotic pizza maker, a commercial kitchen helper, that kind of stuff. We also have a small constellation of specific sector venture funds that we are joint venture partners with. And these are in healthcare. I believe you had Jay Goss as a guest at some point called Wavemaker 360. And we also have something in the sustainable energy side called Thinline, powered by Wavemaker. We hope to expand that constellation to about 4 or 5, possibly 6 sector funds. And I can explain a little bit more why we like doing those things. We're not a fund of funds per se, but we have a different way of joint venturing with these guys and how we help them stand up that practice. And last but not the least is the most recent practice that we have, which is what we're just internally calling the venture strategies practice for now. And what that is we're working with a bunch of family offices who are interested in standing up their own venture practices within their family offices and within their organizations, and helping them stand that up. We co-manage it with them, which means that we get performance fees from them, and at the same time advise them on strategic nature of early stage investments. So for now, we're horizontally integrated. At some point, there's some aspirations to vertically integrate that, but happy to discuss those as well.
Got it. Well, we'll have to come back to the robotic lawnmower at some point. But okay, so within all those pieces, I could just ask a ton of questions about each one of those. But maybe we start with the early stage venture fund that's here in LA that you are running.
Yeah, so in the US side of our early stage practice, we're investing out of our fourth US fund. Our model is we'll invest anywhere from $250,000 up to $2.5 million per company throughout multiple funding cycles. But we typically calibrate that with an initial bite size of anywhere from $250,000 to $500,000, depending on the stage, the size, and the pricing of the round. Our average initial bite size have been hovering in the $400,000 range, and we'd like to buy anywhere from 5 to 8% of a company at the outset. And we will protect that position for as long as the thesis is pointing in the right direction. And as I mentioned, we'll invest up to $2.5 million or a percentage of that existing fund. We don't want to invest more than 3%, 4% in any single name.
I know you'll also do SPVs, right?
Yes. So we've utilized the SPV as more of a strategic tool for us. We would invest in SPVs if, number one, we've outstripped our own funding capability, or we go off thesis and we like something that's not necessarily early stage. We've done that many times as well. I'd say about a third of the SPVs that we've done the last 8-9 years have been to continue to support existing companies within the fund. And those are, for the most part, those will be the same LPs within the fund, and they're just going to go through the SPV. All that means is we've outstripped our own funding capabilities, or we've bumped into our limits, internal limits within the fund. And then about 2/3 of that have been off thesis stuff, such as relativity space, which is completely not early stage, but we like it a lot, so we would get involved in something like that. To kind of give your audience context, the SPVs, the sizes of the SPVs have ranged anywhere from as little as $750,000 to as much as $9 million across multiple companies.
And just to help explain how SPVs usually work, if you're in the seat of sort of a venture capital fund, will you raise a new SPV for a particular investment, or do you have some that sort of stay open? Say if you've got some LPs who want to do any growth round that's coming out of your fund or something.
So the answer is yes and no, which is a very cliche answer, but it is the truth. So we do have what we consider a master SPV. All that means is it's a series LLC that we've established a while back, and we would just fire off one new series of stock for each different name. So we don't commingle the names, but they remain and reside in one master vehicle. So whenever there's an opportunity that comes up that requires us, or that we decide to do an SPV on, then we will light up a new series and then shop that across our LP days.
Okay. No, I asked because I think that you have uniquely done a lot of interesting things about deploying capital in different sorts of vehicles, which I think is interesting.
Mostly necessity, because we started off very, very small, and we've grown over time. We've raised over $400 million across multiple funds, but across those 17 and a half years, we've had to figure out AUM hacks here and there to be able to really get the luxury and flexibility to be able to continue to invest in the companies that we really like.
But a lot of people, I guess a lot of people raise opportunity funds is where I was going.
Yeah.
And this is a similar twist on that same concept.
It is. We do have aspirations of raising a growth fund and opportunity funds, and perhaps even all kinds of different funds within the early stage aspect of it. That's a bit of a distinction for Wavemaker, is the fact that because we practice in both sides of the world, we've been around a little longer than most. We've been able to accumulate and develop a lot of LP relationships. We have over 225 LP relationships across our universe of limited partners. And a lot of those guys are more comfortable writing bigger checks than smaller checks.
Interesting. And now you said this venture strategies, so sort of bleeding into a different part of your practice here. Yep. Is this venture strategies work where you're helping family offices invest directly? Is that what you're doing?
Yes. So what we've learned the last several years is a lot of the family offices, if they can help it, they don't really want to become LPs. They'd like to make direct investments themselves because there's just the allure, their glamour, whatever the reason is. So what we found is, rather than not have the opportunity to work with these guys, why not try to figure out if we can be helpful to them? So that's how it all came about. So it becomes AUM at some point because you have performance fees and you have some service fees along the way. But it's also a great way for us to expand our universe of potential investors. At the same time, we're able to help them because we're able to show them unique access that ordinarily they wouldn't necessarily have.
Is that the main thing that they are wanting? Like, do you teach them things when you call this venture strategies? Are you teaching them things, or is it really a lot about the deal flow?
There's some teachings in there, such as, talking about everybody has different portfolio construction philosophies. We preach our own, whether they take it or not, it's up to them. But we do believe in optionality given where we invest. We're not big believers in high concentration models at this stage.
And has a lot changed in the past few months with COVID in terms of the family offices in particular and what they're looking to invest, or are they looking to slow down their deployment of capital?
Things have slowed down quite a bit. People have really tried to protect their liquid resources in the hopes that they can get a better definition of how this thing will pan out. It's still very uncertain, obviously.
And how do you have all this great network of family offices? I mean, some of it is you've been doing it a long time. Is it sort of that it builds on itself? Like family offices introduce you to their friends?
Yes. So one of the other distinctions that we have is most of our capital comes from Southeast Asia, a large chunk of it at least. I'd say on a percentage basis, in terms of nominal terms, probably about 75% of them come from Southeast Asia. So it's a great advantage for me not to be able to compete or not having to compete with guys like yourselves in the same ecosystem, right? You do tend to meet folks that are interested in making direct investments and are not necessarily interested in becoming LPs, and you do tend to develop those types of relationship. So, it's just the value of being around a long time, I guess.
Okay. Yeah, good. Well, thank you for sharing. And so maybe switching gears entirely and going from, Southeast Asian family offices to, can we talk about robotic lawnmowers and what you're doing? And we don't have to go too deep on the lawnmowers, but just tell me more about the venture studio. I believe it's Buck Jordan, who I've heard his name a lot. I don't think I know him. Tell me more about what you guys are building there.
Yeah, Buck definitely runs that thing and has done a great job doing it. So the whole premise there is to identify a pain point, preferably a big one, as most investors like to get involved in, and then try to validate that pain point with an actual industry practitioner, i.e. a corporate or an industry player that is experiencing that pain point. In that particular example with the autonomous lawnmower, we thought that commercial landscaping had a big gap wherein there's a shortage of labor. I mean, these are very mundane things that most people don't really want to do unless they have to. So there's a shortage of labor, and a good chunk of their P&L really runs on that labor. And so those services are not that high margin. I'm talking about servicing golf courses, servicing college campuses. In commercial landscape, the highest margin products are from the specialized services, such as cutting trees, designing the gardens and all that, but not on the mundane stuff. So the whole premise there is, if this is really a true pain point, can we build an autonomous vehicle or an autonomous product that could service this automatically without any labor? And will this appeal to the corporate or to the commercial landscapers that are doing this? So we approached two commercial landscapers. What we need is validation from you that not only is the problem real, but you would actually be a potential customer if we can deliver the product. So that's what we mean by getting corporate validations. And in this particular case, a company's called Graze. It has pre-orders to the tune of about $20 million from these two commercial landscaper companies. And then, of course, the first one that Buck did was Miso Robotic, which is a commercial kitchen helper that's taking a life of its own. It's got its own 30 employees, raised over $15 million. So we want to be able to replicate those types of successes, and it's fun. I really get engaged with it. And one of the things that we utilize a lot is crowdfunding. That is to enhance consumer awareness, and it's become a really, really viable source of early stage funding for us. Not to mention, it gets that early marketing buzz that helps you market the product when it's all said and done, once you've delivered it.
And so tell me more about crowdfunding. I'm interested and I don't know it very well.
There's different regulations in crowdfunding. The first layer where the masses are allowed to invest limits your ability to raise it up to $1 million. And you have 90 days to do that. And for the most part, most of our companies have done that well. And so aside from the brand awareness of it, it's a bona fide source of capital. And I'm a big fan in anything that democratizes capital formation. I find it hard to believe that the government and all these regulators will allow people to gamble their life away and prohibit them from investing in something that actually has social utility. So we're big fans of it. We realize that not everybody's a big fan of it, but I think it's gotten better. There are two guys that we've worked with quite a bit repetitively, and it's worked out well for us.
There's two people you've worked with, as in, are they two platforms you've worked with? Or are they platforms. Like agencies? Okay, platforms you've worked with.
So we've worked with Start Engine locally here, and we've also worked with Seed Invest.
Okay, got
it. We're open to working with other platforms as well, because a lot of these guys are really getting their processes much better.
And do you usually work with like an agency or someone who's an expert on helping manage the campaigns on these crowdfunding platforms?
No, we manage it internally. So once you get to know us, we're a little bit over-indexed with people. There's 40 of us across all our different practices. So Wavemaker Labs itself has about 13 people plus another 4 or 5 interns. So we do have a fair amount of people that we can manage all those things internally.
Wow, I didn't know Wavemaker Labs had 13 people, because that was going to be another question, which is, do you recruit outside CEOs, or is that part of those 13 people? You've got sort of people who are running these projects, whether they're CEO and title or otherwise.
No, we do recruit outside CEOs. So when I mentioned our personnel count, that number does not include all the CEOs that lead these companies.
So if I am I don't know, there's probably not a scenario in which I have a great idea and I come to Venture Studio. I would come to your venture fund.
We're not an incubator. We don't take outside ideas. And a lot of the companies that we've built so far are internal ideas that we validated with corporate.
Do you think there's something that you've learned? Hopefully you've learned something, but do you think there's something you've learned about how to make a venture studio work? Because it kind of seems like the dream. Like, I want to work on 5 different projects that involve robotic lawnmowers, etc. But I think that making the structure work is sort of a challenge.
Yeah, well, I would never claim that we figured it out, but for the most part, I think a venture studio really should be geared and should be designed to the founders' personalities, in my opinion. There's science, which we're also an investor in. I think they've done a great job trying to figure that out, mostly consumer-facing stuff. So I'm not sure we've figured it out, but we don't have a lot of shared services. We do and we don't. We do have the shared services in terms of the finance team that we handle the financing. We seed every single one of them, but we've kept it small. We stabilized the capital formation aspect of it, wherein we raise permanent capital, and we'll see. Let's have a conversation 7 years from now, see if we're actually successful at it.
So tell me, okay, so you're an investor in science, but then, I am familiar with Jay and his model reasonably well. And then Thin Line Capital, right? Aaron's fund. Line. So tell me more about what you're doing with these affiliate funds, if you will.
Sure. They're affiliate funds, loosely called affiliate funds, only because we're their largest LPs. And these are both, Jay was an existing relationship. When Jay was CEO of RxVantage, I backed him. And we developed a nice rapport. We're fellow parents in school, so there's a lot of affinity there that we developed a good friendship. And when he told me that he wanted to cross over to the venture side of things, he was asking for my advice with certain things, and one thing led to another, and this came about. There's some value in what we're doing because first-time funds are hard. Even if you're a good entrepreneur, first-time funds are really hard because, number one, it's rare that you'll be able to go to an institution to back you unless you have a long-standing relationship with them. So you kind of have to rely on us in a network of family offices and high net worth individuals to get that done. So Wavemaker is a generalist fund for the most part. Healthcare in general is something that I don't believe you can just hack your way into. You have to have a lot of relevant domain knowledge and experience to be able to be good at that. We're not doing it because we want to do it ourselves down the road. We really believe there's a value to having a constellation of affiliate funds or joint venture funds across our network. Sustainable energy was also similar to our interest in healthcare, and it's also something that we didn't think we can hack our way into. So we needed somebody with deep domain knowledge and experience to do that. That's how the whole Aaron thing came about. The way I would put that is, it's all about the people, right? I mean, Aaron, right? I mean, he's a nice mix of nerdiness and real worldness, if you will.
Yeah.
So I figured he'd be a good investor over a period of time. So there are certainly sectors that we will want to explore further. Food tech would be one of them. Fintech obviously is, it powers the entire world. So that's something that I definitely would like to learn about. Although there's some funds locally here that do focus on that. Cannabis probably is something that we're looking into. But we would anchor it, and as I mentioned, we would anchor them on people. If there's no fit on the people aspect of it, it's unlikely that we'll be able to get comfortable.
I just feel like every aspiring VC operator today, aspiring VC is going to come reach out to you and want your help, want you as an anchor in their new fund. And so when you're the anchor, I assume that's, can you tell me more about how that relationship works?
Sure. So we define anchor as at least 20% of the fund. That's our definition of an anchor. Anything less than that, they may probably not consider it as an anchor. We do have ownership on the GP level. and we sit on the investor committee side of things. We don't do the day-to-day heavy lifting. That we leave that up to the professionals to do.
Yeah. I think it sounds like a great thing, and both Thin Line and Wavemaker Health are both in Pasadena, so I'm a particular fan of those.
Yeah, I know, by coincidence. I don't know how that happens, but at least we've served Pasadena well.
Eric, you're welcome to start a couple more here in Pasadena. It's a great place. Tell me more about your personal investing and maybe how you're coaching founders now, or what you're looking for. I've heard you talk about you're looking for capital efficient businesses. Tell me, what does that mean to you? What are you looking for when you're evaluating opportunities?
Sure. So the fundamental premise we believe in as a group is we believe that businesses of all shapes and sizes need to adopt the best technologies for them to remain competitive or to be competitive, period. We believe those anchors ought to be in the automation side, the data side, and then the intelligence side. I think if you have those three elements, then you'll have a nice operating system, if you will, within your business for you to be able to become competitive. So in other words, we're constantly looking for those type of opportunities anchored by automation technologies that eventually lead to data and intelligence gathering. That's really the high level of what we're looking at. However, because we live in LA, we do tend to look at a lot of digital media stuff as well, aside also on the consumer facing side. But 2/3 to 3/4 of our investments the last 2 to 3 years have been anchored by enterprise facing businesses.
Are you exclusively LA focused? I should know this.
No, we're not.
Okay.
We are located in LA. I've lived in LA since 1991. I'd say about 2/3, half to 2/3 of our investments are within Southern California, broadly defined as Santa Barbara to San Diego.
Do you find that you're able to, how do you stay fresh as a VC? And I mean, VC is incredibly intellectually stimulating, but you're not as fresh on the operating side. Or do you feel like you're able to stay fresh?
Yeah, great question. I think I've never thought of it from that perspective, but I guess one subliminal way for us to have stayed fresh was the fact that we've experimented in different models within the early stage side. We consider ourselves a startup ourselves. We have 40 people, including the partners that we have to deal with on a regular basis. I'm a big fan of staying close with your entrepreneurs, staying friends with them. You kind of have to live vicariously through them to remain fresh. Is I think the best way to remain fresh. Otherwise, operating businesses and deploying capital or capital allocators are two different businesses, right? So you kind of just have to pick your poison and make sure that you can relate to both sides. But having an operating background has helped me relate to the pains and sufferings that all our founders are going through.
Well, I really like that. And I didn't mean it as, it sounded more accusatory than I meant it. I really like that staying close to your founders. And I realize that I've been talking for a long time, but I would love to hear some of that story of you building your business. I think we kind of missed your story as a founder, maybe how you built your first business.
Sure. I was a bit of a misfit, and the reason I didn't start with a startup was because I had bills to pay, and I thought that I could learn from big corporate. So I worked for big corporate for a little bit, close to 5 years. I was with Arthur Andersen's retail consulting division here in downtown LA for a little bit. But I've always known that I wanted to do my own thing, so I left in 1995. And I think I just got lucky with timing. 1995 was around the time when the first commercialization of the web was happening. So I figured out what I wanted to do or what I could do. I built an e-commerce startup focusing on specialty foods. And I'm talking about specialty foods. I'm talking about our sort of Northern European cuisines that are rare here in the US. So that's the way I got started. Got lucky, had plenty of false starts, but figured out the supply chain eventually and built it up to a nice, decent business where it got sold to a strategic in summer of 1999. And I wanted to continue the momentum of that. I've always been entrepreneurial. I've always been interested in business in general ever since I was growing up. So I wanted to continue the momentum. So I got involved with another co-founder to start an ISP. It's a simple ISP. Our product was a simple narrowband connectivity. So think of your modems back then with those funky sounds. So that was a little bit more mercenary in our approach. We wanted to identify an underserved market and build it up to a certain subscriber base with the thought that if we can do that, the national providers at that time, Earthlink, United Online, et cetera, would be interested. So we successfully sold it at the end of 2002. Even when I first started my first venture fund, I never really considered myself as a traditional venture capitalist. I thought that this was going to be a nice pit stop. I anchored that first fund with my own personal capital. So, and then all my LPs then were friends. So I had a lot of flexibility to be able to go back and forth. And the reason for that big gap was because I thought there was going to be a third idea. And little did I know that there was not going to be a third idea. But I guess this was the third startup that I was reserving myself for. It just took me a while to realize it.
And what do you think of now? You can't deny that you are 100% a VC now. Well, you've got a lot of things going. What do you think of the VC world?
I like it a lot. I think there is an actual, in the risk of romanticizing it, I think there is an actual social utility to it that's much better than our cohorts from the PE and the hedge fund world. I know some people there. They're much bigger, faster culture, creates a lot more wealth much faster. But I just don't see that social utility in that aspect of it. I like it because as you mentioned earlier, it's intellectually stimulating, and so it's perfect for curious folks like myself. I like the social utility of it. One of my gifts is I've been gifted to be very comfortable being uncomfortable, and I think it's a perfect venue for early stage venture is a perfect venue for that.
What do you mean about being uncomfortable? I'm really interested. I think I'm uncomfortable being uncomfortable, and I want to learn how to be more comfortable.
No, I may have said that incorrectly. I meant was I'm comfortable being uncomfortable is what I meant.
Right, but how did you get to be comfortable being uncomfortable, or in what circumstances?
Well, you know what? I probably attribute this to my operating experience for 7 years. There's a lot of moments where you were 2 weeks away from running out of cash. You were a month away from going out of business, that type of thing. And you kind of just have to train yourself to react to those things.
Well, great. It was fun to get to know you a little bit better. And fun
likewise,
to get
thank you.
Yeah, no, and great to have you on the show and learn a lot more about what you're building at Wavemaker.
Great. Thanks for having me. It's been a lot of fun.